American consumers just issued their biggest warning yet. As you're about to see, it's going to send the global economy right to its breaking point. Now, let's turn to Bloomberg. I want you to see what just happened as U.S. consumer sentiment falls to the lowest since May on job worries. Now, if you remember, what did we see in the consumer sentiment surveys? They plunged and then they rebounded back as the stock market surged higher. Consumers got optimistic that finally things were turning around. And then they didn't. And now we're seeing sentiment reverse direction. It's plunging once again. And this has major implications. Now, I want you to understand why this is so important. Because we've got issues with inventories. And that's only just the beginning. Because remember, this all backfeeds right up to the global manufacturing sector. It doesn't stop there because now with the holiday season in clear focus, it's all about the spending power of U.S. consumers. And yet, what are we hearing from survey after survey? Spending is going to decline, and that's the base case scenario. That's if things don't get worse. Right now, based on what I'm seeing, things are likely to get much worse by the end of the year. And then we have the labor market, and this has been the biggest warning of all from consumers. You know, it's one thing that the economy is slowing down, but when people start worrying about losing their job, when their hours are getting cut, and then they look out at the labor market and they see there's little to no opportunity to re-enter it, well, then you have a serious issue, and this is going to push the global economy right to its breaking point. Now, let's dive into the University of Michigan Consumer Sentiment Survey, because they just said that sentiment has fallen to its 4-month low. And you can see that rebound here off this really low point, and then everybody was breathing a sigh of relief, and I said, hang tight, this isn't going to last. Sure enough, despite the stock market being near all-time highs, sentiment once again plunging. Now, the experts are saying this has everything to do with inflation expectations surging higher. It doesn't really have much to do with that. It's part of the component here, but the real issue, it's all about the labor market. The problem is, it too is at a breaking point. The preliminary September sentiment index declined to 55.4 from 58.2 in August. And again, this was below everybody's expectations. Nobody thought that the economy was going to roll over again. And that's the issue we're facing right now. Because if you think about the global economy, everybody's looking at the U.S. consumer and saying, look, we need you to spend and spend big and all the way through the end of the year. Because if you don't, well, next thing you know, all this massive inventory overhang is going to put the global manufacturing sector on ice, and then it's going to start rolling all the way downhill into the labor market, and then you're going to see companies, just like we saw with the energy sector, they're going to start laying off and in droves. But even if all of that happens, it doesn't mean you can't make money in the markets. Let me give you an update on that trade on GDXJ. We put this back to all of our subscribers on the 5th. Now, this comes from our new Metre strategy that we recently optimized. Now, everybody tells you that, look, when it comes to trading systems, one size fits all. But we have done something completely unique. We've optimized every signal on a per security basis, giving us an edge that nobody else has. And right now, you can get our new optimized MetaStrategy trades at no additional charge. All you have to do is grab those links in the description below, sign up for either report, and use a coupon code for your free 30-day trial. Jump in because we're starting to change the way people trade and make money in the markets. And people are going to be looking to make money in a big way because right now inflation's still running too hot, labor market weakening, and I want you to see why I don't buy into this inflation expectations. Now, this doesn't show the preliminary data, but that has surged higher. But remember, one of the key components is gasoline prices, and they haven't budged. Because we've seen in past cycles when inflation expectations rise and gas prices don't, you see them coming right back down. But that's not what consumers are worried about. They're worried about their ability to go out and spend because they believe if prices go up, well, that means they're going to be able to purchase fewer goods. That's a problem because they're already reaching a point, at least financially, at a breaking point. And this means from a spending perspective, they're going to have to make even further cutbacks, and something nobody wants to do. Now, the problem is consumers expect prices to rise at an annual rate of 4.8% over the next year. That's unchanged from last month. And they saw costs rising at an annual rate of 3.9% over the next 5 to 10 years. That's a jump from the 3.5% rate seen last month. So as we look at those holiday surveys, what are we hearing? Consumers are saying, look, we're going to spend more. Well, they're going to have to because of inflation. But they're all saying, look, we're going to get less. We're going to buy fewer things because our dollar doesn't go as far. Now, you think about this from an inventory perspective, from a manufacturing perspective. If all of this inventory overhang doesn't get worked through, it's going to put the ice on the manufacturing sector because orders are going to dry up. Now, the problem is we're already seeing that happen. And the issue for the labor market is, but when you take a look at the backlogs, well, they're getting worked through at a very rapid pace. Once those are gone, it's game over for the manufacturing sector. And let's take a look at the real impact of inflation expectations, because while people think inflation is going to go higher, gasoline prices say not a chance. But remember, it's all about spending, because even though people right now believe that businesses are just going to continue to raise prices and raise them again and raise them some more, the bottom line is if you've ever owned a business and you don't have customers, you can't keep raising your prices. Now, this is something that I'm seeing in the economy right now. But let's take a look at this chart, and I'm going to give you a little bit of a story here, but let's take a look, because we've seen in the past where consumers think inflation expectations are going to surge like they did in 2005. Retail sales rolled over and said, nope, not going to happen at all. They thought the same thing in the financial crisis. But once again, retail sales trumped that, saying, look, if they're dropping, so is inflation. You saw that again, 2011, 2022, and now we're going to see it again. So I don't buy into this inflation expectation story. I don't think that has anything really to do with why consumers are so bleak here. I think they're spot on. It gets everything to do with the labor market, and for very good reasons. Consumers' expected probability of personal job losses grew sharply this year and ticked up in September as well. This is suggesting that consumers are indeed concerned they may be personally affected by any negative developments in the labor market. But again, this all comes back to backlogs. See, the problem with the economy right now is when you have too much inventory and you don't have enough demand, what happens is the new order book, well, it starts to dry up. Now, if you have workers and you have backlogs, which we've had a lot of, in fact, we've had about 3 years worth of, well, you just put your workforce in catch-up mode and say, look, go work on all these old orders. But the problem right now is workers are seeing that these old orders are drying up and there's not enough new orders coming in. And once we get to that inflection point, well, the labor market's going to hit a breaking point as well. And that's exactly what we're starting to see in the surveys. Let's take a look at the University of Michigan Consumer Sentiment Survey in blue against average weekly hours of production of non-supervisory employees. And what we can see is where sentiment is going has everything to do with paychecks. In fact, we see hours worked start to drop, and then we see sentiment follow. And that's the issue we're facing right now, is that big drop in sentiment. I said, look, I think hours are about to come plunging down. And then what happened? The trade war got extended a little bit. And it's, again, more front running, more building products ahead of time, more inventory building. And what happened? Workers got a little excited. They said, okay, maybe things are turning around. And now they're not, because their hours aren't picking up and inflation is continuing to rise, meaning their paychecks are getting smaller and smaller relative to inflation. And heading into the holiday season, well, it's not good. But persistent worries about tariffs weighed in on sentiment, with about 60% of surveyed consumers providing unprompted comments about levies. Now, this is a real issue, because last night I went out and I talked to a manager of a local restaurant, and this is what she said. She says, look, we're at a point where our prices are going up, but we can't raise our menu prices. We might have to raise them a little bit, but we're going to have to absorb a lot of the increase. And I said, this is really fascinating. Can you tell me why? She says, look at the prices. We already know we're at the point where if we raise them, our business is going to drop. So we're switching modes here. We're going to the competition with everybody else. We're looking for market share here. We're looking to make a change, because we know that consumers can't afford higher prices. We know they're at a breaking point. And for the global economy, if the U.S. consumer cuts back their spending, well, everybody else is going to fall. And that's why right now, my friends, we're at a breaking point. That's what the University of Michigan survey is saying. But the problem is the outlook is even worse because a survey showed current conditions gauge declined to 61.2 this month from 61.7 in August, while expectations, and this is looking out 6 months, fell from 51.8 to 55.9. So what you're seeing is, look, consumers aren't just saying, look, things aren't good for us now. The problem is they're looking out and saying, we don't see a change. We don't think they're getting better. But if you think about it, it all comes back to the new order book. There isn't enough new orders. There's too much inventory and the backlogs are going away. And the problem is businesses are well aware, much like that Ross, and say, look, we see prices going up, but we know consumers can't afford it. We know demand is dropping. We have to become more competitive. We have to become better at what we do because we have to make up for this in volume. And that's a problem because you look at China's manufacturing sector. It's exactly what's happening there. And what do you get from that? Well, you get disinflation. And in some cases, particularly when inventories get stagnant, you get deflation as they look to dump it. And here you can see the University of Michigan, as we look at the sentiment survey, conditions index, and the expectations are all rolling over, all turning down, all red flags that are telling us that the U.S. consumer has indeed reached their breaking point. And for the global economy, it means game over. And there's further evidence. Let's turn to the oil patch as West Texas Intermediate holds gains despite biggest crude and product build. Well, that's since 2023. And here you can see gasoline inventories up over 1.4 million barrels. Distillates. Now, if you don't know what that is, think jet fuel. That up over 4.7 million barrels. So as consumers struggle with inflation, what are they doing? They're cutting back on their energy usage. Now think about this summer. We've all been through this. Big air conditioning bills because electric prices went up and it was really hot. You can think a lot of families are waiting and eager for the fall season for cooler weather to take some pressure off their finances. And you can see when people cut back on their energy usage, it means they too are at a breaking point. But Congress is buying into this as well as the Congressional Budget Office sees lower U.S. growth, higher unemployment this year, saying, look, things are going to get worse. The problem is, I think it's going to be far worse than they think. The report shows unemployment peaking at a higher rate of 4.5% at the end of this year. Private forecasters similarly anticipate a slower pace of growth in 2025 before picking up somewhat next year. And my friends, that's if we don't have a recession. So what they're saying is, look, the economy is going to get worse. The labor market is going to get worse, but then it's going to reach a point where it's going to plateau. The problem is, it's not going to plateau because demand continues to drop at a rapid pace. What this is suggesting, the 4.5% unemployment rate, that's if things stay where they're at now. The problem is, if we hit a recession, that number's going to go up, and a lot. And corporate America is buying into that too as they bet on rate cuts with longer dated holdings. And companies that add duration of their portfolios continue to invest in relatively short-dated products just at the longer end of that spectrum. In the case of the recent Clearwater data, companies' average portfolio duration of around 8 months is the highest in 3 years. So a lot of companies, and I know there's this big thing about holding Bitcoin or Ethereum or some other crypto instead of cash, but most major companies keep their money in money markets or very short-term treasuries. Now they're saying, look, we know things are going to get worse. We know the Fed's going to cut. And they're not cutting because, well, inflation's cooling off. They're cutting because the labor market's falling. And why do we know that? Because we're laying off too. So companies are picking up duration. They know the Fed's going to cut. They want to put some money in the pocket because they know as consumers cut back their spending, well, it means corporate profits are going to get slashed. And you can see the knock-on effects as we look around the world. German factory orders unexpectedly drop, hurts rebound hopes. Well, it's getting worse because, again, when American consumers cut back, everybody feels the pain. And incoming orders have now fallen for the third month in a row. And institutions have revised down their growth forecast for this year and next. And again, it's all about the new order book here, because as demand continues to fall and inventory levels stay elevated, what happens? You see cutbacks in new orders. And in particularly in Germany, you talk about the manufacturing heartbeat of the European Union. What have we seen there? 3 years of backlogs. And what happened over the last couple months? Those backlogs, well, they're almost running out. And just as I predicted, as they run out, that means people are hitting the unemployment line. That's exactly what we're seeing. The problem is the spillover effect. It's telling us when U.S. consumers hit their breaking point and stop spending, the rest of the world goes right into a recession. Overall, the hard economic data in recent months has been disappointing, and here's the issue. It's not going to get better. That's the problem. It's not getting better because the global economy is stagnating. It's stalling out here. And then the issue is you look at the sentiment survey, it's rolling over. And that, my friends, is a strong indicator. Again, we're at the breaking point, and nobody's a winner after that. Inflation fears and stagnation stall agrees before UK budget, and it's not just Germany, it's all the way up north. As hopes for more reductions in borrowing costs this year were dampened by further signs of mounting inflation worries among consumers. And this is an issue I think the Fed's going to be facing next Wednesday, because one of the issues is, well, look, we need to cut rates because the labor market's softening up and weakening. The other problem is, what did we just see in the CPI data? Well, a month-over-month data jumped up, and this is a big response from the producer price index, I believe, the months before. But if you still look at the issues here, what happened to the PPI? Well, it dropped way up because businesses, just like that restaurant, are saying, look, we've raised our prices all we can, but we've reached the tipping point. We can't go any further. Problem is, the Fed's going to be looking at that CPI data. And again, the Fed responds with a lag. That's why I think a quarter basis point cut is the likely outcome. And then we're going to see further cuts after that. This is what corporate America is saying. That is until the labor market goes bust. And the figures will deepen concerns that policymakers are losing control of public perceptions following price hikes. That's expected to see inflation hit 4% in September on the back of surging food bills. So again, you look at perception here, you see central bankers saying, look, we're going to bring inflation down. Well, so much for that, because we know monetary policy doesn't work that way. But the real issue here for consumers all over the world, and again, this isn't just an American issue. You have food prices rising, you have energy prices rising, you have rent prices rising. And what does that mean? Less money to spend on the discretionary side of the economy. Those inventory levels, well, they still stay elevated. You get cuts to the manufacturing sector, starts to lay off, and then you see that fall all through the supply chain, just like we are seeing in the energy sector right now. My friends, what we're at is the breaking point. This is America's biggest warning to the world, because what it means is we're on the cusp of the very next recession. But even if the markets start to blow up, it doesn't mean you can't make money trading them. Let's take a look, because I want you to see this compared to another popular strategy. But let's take a look at our Metre strategy. Now, this is fully optimized. Now, you can see we beat buy and hold, and this is extremely rare. You don't see this happen ever with trading strategies. Look at our win rate, 66%, generating 69 trades over a 2-year period on SPY. Our max drawdown just over 7%. Now, you may have seen I've compared this to the Bravo 9 strategy, and again, this is a one-size-fits-all. My buddy Jay Bravo says this works for everything, and I said there's no way it works for everything. Well, sure enough, look at this. If you're trading that instead of our Metre strategy, well, look at this. You're getting half the number of trades. Your win rate is just over 50%, which is good, and not as good as it could be, and you're still getting the same drawdown, and you're massively underperforming on top of that. Now, what is our Metre strategy? It's an advanced trading system that combines 9 trading strategies into a single intelligent signal generator. It's optimized for trades over a 10-day period, generating a massive number of trades with a success rate, as you can see, over 60%. Again, my friends, this is unheard of. And what did we do? We optimize it on a per security basis. Again, nobody's done this. Everybody else says, look, just follow our system and use it on anything. I said, no, that's not how it works. Now, how do you get our Metre strategy trades? Well, you just have to sign up for one of our reports, whether it's our CTA Timer Pro report that trades against the machines, or a Momentum Timer Pro report that trades momentum indicators. Either way, you get both of the reports depending on which one you sign up for. You get the tradable signals, and right now, you get the optimized Metre strategy signals at no additional charge. You get my opinion on the best trades. We give you risk control levels, a full tracking of all our open trades and returns, a weekly update. And again, here's the best part. You can compare us to any other strategy you're using for free. All you got to do is grab those links in the description below, use a coupon code for your free 30-day trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.